Preparing for a financial analyst at PepsiCo interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at PepsiCo? I am attracted to PepsiCo because it combines iconic brands with a complex global operating model. A financial analyst can influence decisions across beverages, convenient foods, pricing, promotions, supply chain, and investment. I enjoy turning operating data into recommendations, not merely reporting historical results. PepsiCo's scale would also let me learn how analysts balance volume growth, revenue management, inflation, foreign exchange, and productivity. I would bring strong modeling discipline, curiosity, and a practical understanding of business drivers. While answering, connect PepsiCo's global brands, diversified food and beverage portfolio, operating scale, and consumer exposure to your analytical interests, while explaining how the role supports decisions on growth, pricing, costs, and capital allocation. Question 2. Walk me through how you would analyze PepsiCo's quarterly performance. I would begin with reported and organic revenue, separating volume, price, mix, acquisitions, divestitures, and currency effects. Next, I would examine gross margin through commodity costs, pricing, productivity, and product mix, then review operating expenses and segment profit. I would compare actual results with budget, forecast, and prior year, investigate material variances with business partners, and assess cash flow, working capital, and guidance implications. Finally, I would summarize the few drivers that require management action. Make sure to cover revenue, volume, price and mix, gross margin, operating expenses, operating profit, cash flow, segment performance versus plan and versus prior year comparisons, plus operational explanations behind each material variance. Question 3. How would you build a monthly forecast for a PepsiCo business unit? I would start with an integrated driver-based model rather than simply applying last year's growth rate. Volume would reflect category trends, distribution, customers, innovation, and seasonality. Revenue would then incorporate pricing, mix, promotions, and currency. Costs would include commodities, freight, labor, manufacturing, productivity, and marketing. I would reconcile the forecast to the general ledger, document assumptions, create upside and downside cases, and review changes with sales, supply chain, and brand teams before finalizing. In your answer, talk about historical run rates, customer and product level assumptions, volume, pricing, mix, commodities, labor, promotional spending, seasonality, FX, scenario analysis, and frequent collaboration with commercial and operations teams. Question 4. Explain the difference between volume, price, and mix in PepsiCo revenue growth. Volume is the change in physical units, cases, or servings sold. Price is the effect of higher or lower realized pricing on comparable products. Mix captures the impact of customers buying different products, pack sizes, channels, or geographies. For example, premium single-serve products may improve revenue and margin even if total units are flat. I would analyze the three separately because strong reported growth can conceal declining volume, while favorable mix can materially improve profitability. Be sure to mention that volume measures units or cases, price reflects realized pricing, and mix captures shifts among products, packages, channels, or geographies, with practical implications for margins and revenue quality. Question 5. How would inflation in commodities affect PepsiCo's financial statements? Higher commodity costs initially increase inventory and cost of sales, pressuring gross margin and operating profit if prices remain unchanged. PepsiCo may respond through list price increases, pack or package changes, productivity, sourcing, hedging, and promotional adjustments. The timing can differ because existing inventory and contracts delay the income statement impact. I would also assess volume elasticity, mix, customer acceptance, and working capital, since inflation can raise both cash invested in inventory and nominal revenue. Focus on major inputs such as potatoes, corn, sugar, packaging, fuel, and labor. Explain gross margin pressure, pricing responses, inventory timing, hedging, productivity, consumer elasticity, and potential effects on cash flow. Question 6. What is net revenue management, and why is it important at PepsiCo? Net revenue management is the disciplined process of improving realized revenue and profit through pricing, pack sizes, promotions, assortment, and channel choices. At PepsiCo, it matters because consumers buy products across many price points and occasions, while retailers negotiate actively. I would evaluate both revenue and contribution margin, not just list price increases, and monitor volume elasticity, competitive moves, and consumer trade down. Effective revenue management should fund growth without damaging brand equity or long-term market share. In your answer, cover pricing, pack architecture, promotions, assortment, channel mix, elasticity, consumer affordability, revenue growth management, and the need to protect both market share and contribution margin. Question 7. How would you evaluate a pricing increase on a PepsiCo product? I would quantify the expected unit decline using historical elasticity, consumer research, competitive pricing, and channel-specific behavior. Then I would calculate incremental revenue and contribution profit after trade spending, manufacturing costs, logistics, and potential mix changes. I would test alternatives such as a smaller package, selective customer increases, or reduced promotions. My recommendation would include base, upside, and downside scenarios, along with market share and brand risks, because maximizing price per unit is not always the best outcome. Mention baseline volume, price elasticity, competitor pricing, customer margins, trade promotion, pack alternatives, incremental revenue, contribution profit, market share, and sensitivity analysis before recommending an action. Question 8. Describe how foreign exchange affects PepsiCo's reported results. Translation exposure arises when international results are converted into PepsiCo's reporting currency, so a weaker local currency can reduce reported revenue and profit even when local performance is stable. Transaction exposure affects foreign currency purchases, sales, or liabilities directly. I would compare reported and constant currency growth, examine geographic contributions, and understand hedging impacts. I would not ignore currency effects. Instead, I would separate them transparently while still evaluating the underlying operating performance and cash consequences. Make sure to distinguish transaction and translation exposure, explain constant currency reporting, identify revenue and profit impacts, and discuss hedging, local pricing, geographic mix, and limitations of adjusted metrics. Question 9. What working capital drivers would you monitor at PepsiCo? I would monitor days sales outstanding, inventory days, payable days, and the resulting cash conversion cycle, while also reviewing absolute balances and seasonality. Receivables may change with customer mix and payment terms. Inventory reflects demand forecasts, commodity costs, production cycles, and service requirements. Payables depend on supplier terms and procurement strategy. I would investigate unusual movements by business unit and SKU because reducing inventory too aggressively can create stockouts and lost sales. Discuss receivables, inventory, payables, days metrics, seasonality, customer terms, production planning, commodity inflation, stockouts, obsolete inventory, cash conversion, and trade-offs between efficiency and service levels. Question 10. How do the three financial statements connect in a PepsiCo forecast? Revenue and operating assumptions determine the income statement, including profit after tax. Net income flows into retained earnings and begins the operating section of the cash flow statement, where non-cash items and working capital changes reconcile earnings to cash. Capital expenditures increase fixed assets and reduce investing cash flow, while depreciation later reduces earnings without a current cash outflow. Debt, dividends, and share repurchases affect financing cash flow and the balance sheet. I would check that all links reconcile. In your answer, explain how revenue and expenses drive the income statement. Net income affects retained earnings and cash flow, balance sheet accounts drive working capital, and capex and debt connect to cash and financing. Question 11. Tell me about a time you identified a significant variance. In a prior internship, monthly logistics expense was materially above budget. I reconciled the general ledger to shipment data, isolated the variance by lane and carrier, and found that several expedited shipments had been coded to the wrong cost center. I confirmed the issue with operations, corrected the forecast, and created an exception report for future periods. The result improved reporting accuracy and helped the team address the underlying scheduling problem. I learned to combine accounting evidence with operational context. Focus on the situation, analytical approach, root cause investigation, stakeholders consulted, corrective action, quantified impact, and lesson learned, using a concise star structure rather than describing only the spreadsheet. Question 12. How would you assess whether a PepsiCo capital project is financially attractive? I would model incremental after-tax cash flows, including construction costs, maintenance capex, working capital, labor, productivity benefits, tax effects, and terminal value where appropriate. I would calculate NPV using a risk-appropriate discount rate, alongside IRR and payback for decision context. I would stress-test utilization, commodity costs, timing, and savings realization. A project with an attractive return still requires capacity, supply chain, sustainability, and strategic review, so I would present both financial and operational conclusions. Be sure to mention incremental cash flows, initial capex, maintenance spending, working capital, taxes, useful life, NPV, payback, operational benefits, scenario analysis, and strategic considerations beyond headline returns. Question 13. What financial metrics would you use to evaluate a PepsiCo segment? I would start with organic revenue growth, separating volume from price and mix, then evaluate gross margin and operating margin against plan and prior year. I would review productivity, advertising and marketing investment, market share, working capital, operating cash flow, and return on invested capital. The appropriate emphasis depends on the segment's maturity and strategy. For example, a growth platform may accept near-term margin investment, while an established category should demonstrate disciplined cash generation. Cover organic revenue growth, volume, price and mix, gross and operating margin, EBITDA where relevant, productivity, market share, cash conversion, return on invested capital, and comparison with targets and peers. Question 14. How would you investigate an unfavorable gross margin variance? I would bridge gross margin from budget to actual by separating price, volume, mix, commodities, packaging, freight, labor, productivity, manufacturing absorption, foreign exchange, and accounting items. I would validate the bridge against the ledger and operational reports, then identify whether the issue is temporary or structural. For instance, unfavorable commodity costs may be offset later by pricing, whereas poor plant utilization may require a capacity or production response. I would quantify each driver and assign owners. Mention price realization, product and channel mix, commodities, packaging, freight, manufacturing efficiency, fixed cost absorption, inventory adjustments, foreign exchange, and reconciliation to both operational and accounting data. Question 15. What controls are important in financial planning and analysis? Strong FP and controls ensure that decisions rely on complete, accurate, and authorized information. I would use controlled data sources, clear file ownership, version history, documented assumptions, locked formulas, and independent review of material changes. Actuals should reconcile to the ledger, while estimates and management adjustments should be labeled and supported. Access should be role-based, and forecast submissions should have approval evidence. These controls reduce model errors and preserve trust without making the planning process unnecessarily slow. In your answer, discuss data integrity, version control, documented assumptions, review evidence, access controls, reconciliations, segregation of duties, forecast approvals, and clear distinction between actuals, estimates, and management adjustments. Question 16. How would you use Excel or other tools to improve PepsiCo reporting? I would use Excel for driver-based modeling, pivots, sensitivity tables, and transparent variance bridges, while using Power Query or similar tools to standardize recurring data pulls. I would automate repetitive formatting and validation, add checks for missing data and balance sheet inconsistencies, and present key drivers through concise dashboards. I would document assumptions and keep source data separate from calculations. Automation should improve speed and control, not create an opaque model that stakeholders cannot challenge. Focus on building reliable models, Power Query or equivalent data preparation, pivot tables, scenario controls, error checks, automation, visualization, documentation, and maintaining transparent outputs that business partners can understand. Question 17. How would you forecast demand for a seasonal PepsiCo product? I would establish a baseline using several years of weekly history, adjusting for unusual promotions, stockouts, distribution changes, and portfolio shifts. I would incorporate holidays, weather sensitivity, customer programs, advertising, innovation, and planned pricing. The forecast should be reviewed with sales and supply chain because commercial commitments and production constraints can materially change demand. I would track forecast accuracy by period and SKU, update assumptions frequently, and create upside and downside cases for inventory planning. Mention historical seasonality, baseline trends, promotions, holidays, weather, distribution changes, innovation, customer plans, inventory constraints, statistical forecasting, and collaboration between commercial and supply chain teams. Question 18. What would you do if sales wanted a promotion that reduced short-term profit? I would not reject the promotion based only on the headline discount. I would compare promoted volume with the baseline, estimate cannibalization and pull forward, include retailer trade spending and incremental logistics costs, and calculate contribution profit. I would also consider strategic goals such as gaining distribution, defending share, or introducing a product. If approved, I would define success metrics beforehand and perform a post-event review. That approach balances near-term economics with longer-term customer and brand value. Be sure to discuss incremental volume, baseline sales, cannibalization, trade spend, retailer economics, contribution margin, customer lifetime value, strategic objectives, and post-promotion measurement. Question 19. Describe a time you had to explain financial analysis to a non-finance partner. I once explained a budget overrun to a project manager who was unfamiliar with accounting terminology. Instead of presenting a complex variance report, I used a 3-step bridge showing the original budget, the cost drivers, and the revised outlook. I explained which costs were controllable and which were timing-related, then agreed on actions and owners. The manager could challenge the assumptions, and the revised process improved forecast quality. I learned that clarity and relevance matter more than technical complexity. Focus on simplifying the message, leading with the business implication, avoiding jargon, using a clear visual or bridge, checking understanding, listening to operational concerns, and translating analysis into an actionable recommendation. Question 20. If PepsiCo missed its forecast, how would you determine whether the forecast process or execution was at fault? I would decompose the miss into forecast error and execution components. First, I would compare assumed volume, pricing, mix, commodities, currency, promotions, and costs with actual outcomes. Then I would determine whether the assumptions were unreasonable, information changed after submission, or execution failed against a sound plan. I would review bias across prior forecasts, identify accountable process steps, and recommend better data, shorter update cycles, or scenario triggers. The goal is learning and improved decisions, not assigning blame. In your answer, separate forecast accuracy from business performance, compare assumptions with actual drivers, analyze timing and accountability, test bias, review external shocks, and recommend specific process improvements. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.